Okay, thank you very much for the last panel, which was the more traditional finance, let's say. The next panel is called Non-Standard Finance, maybe Alternative Finance is a better title. Our moderator, Mr. Brett Esber, partner at Blank Rome. So, Brett, whenever you're mic'd up, please, it's over to you. Thank you.
Okay, thank you, Kevin. As Kevin said, my name is Brett Esber. I'm a partner in the Maritime Practice Group at Blank Rome. I know that we are the panel immediately before lunch, and I'm sure there's an appetite for lunch, but something tells me there's a greater appetite for finance. So hopefully we'll be able to keep the attention of our audience for the next, I think we have 25 minutes or thereabouts. Okay, what I'm going to do is I'd like to make just 2 minutes of introductory remarks, maybe not even 2 minutes, to set the stage for our discussion. I'm then going to introduce the panel, and we are going to proceed with a question and answer format. So the topic of the panel, as Kevin said, is non-standard finance. So what do we mean by non-standard finance? Well, by definition, we mean sources of finance that are not standard or typical sources of funding to the shipping industry. As we all know, historically, the shipping industry has consisted of privately owned, usually family-owned companies that are financed by equity contributions from the owners, the reinvestment of earnings, and vessel-secured loans from the traditional shipping banks. That was what was considered standard financing for shipping. As the industry has grown and as companies have grown, they've started to access the capital markets. So, currently standard financing also includes sort of common stock and bond offerings to the extent that those capital markets are open. So when we talk about non-standard finance, we're talking about sources of funding other than equity contributions from the owners, reinvestment of earnings, loans from commercial banks, and kind of standard offerings of stock and bonds. It's things other than those. Identifying these sources of funding has never been more important to the shipping industry. In the current prolonged and severe market downturn, the greatest challenge to survival is often liquidity. No one knows when the recovery is going to begin, and for many companies, they simply just hope to survive long enough to see it, and that requires funding. At the same time, liquidity is needed to clear the market. In other words, to fund asset transfers that result in marking assets down to market, taking losses so our market can reset itself. Those market clearing transactions, whether they involve sale and purchase of secondhand ships for continued operation or scrapping, court supervised or consensual restructuring of a company's capital structure, or market consolidating M&A activity, we need all of that to help this market recover, but that requires funding, and standard financing sources are clearly inadequate or unwilling to provide the funding that is needed for those purposes. So we have to look to non-standard financing sources. What are those sources? How are they structured? Who's offering them? What kinds of companies have access to them, and for what purposes? So that's our topic. To address these questions, we've got assembled here on the stage some folks who offer non-standard finance, or in George's case, help people put those structures in place. I'd like to introduce them. To my right is Steve Baffico. Steve is the executive chairman of Global Marine Transport Capital. Next to Stephen is George Paleokrassas, and George is a partner at Watson, Farley & Williams in Athens. And then next to George, we have Philipp Wünschmann, who is head of shipping in the corporate banking and international shipping department at Berenberg. So what I'd like to do is just start off by asking each of our panelists to briefly describe the kind of non-standard or alternative financing you provide to the shipping industry. Give me a couple of examples of deals you've done recently, and in the case of George, you can talk about the kinds of deals you've been involved with over the past couple of years. So why don't we start, Steve, with you? What have you been doing?
Sure. So over the last couple of years, we've been very active, focused primarily on privately owned and operated seasoned middle market operators. Global Marine Transport Capital was conceived, I think, in the end of about a couple of years ago, as we saw kind of the mass exodus of traditional capital as you heard the previous panel, with a new kind of regulatory overlay and structural changes to the industry. Our view was that the shipping finance industry was really changed for a long period of time in a secular sense. And so what it opened up is a very large market of private middle market operators who had traditionally depended on that type of financing, and that was gone. So we saw a large void to fill, stepping as an alternative capital provider, focused really on senior secured, first lien, middle market transactions, 5 to 15-year-old type of utility assets, 50 to 60% advance rates, and a certainly higher cost of capital than had traditionally been probably correlated with that part of the market, but one that we thought was probably more commensurate with the risk in that type of borrower.
Yeah, well, let's come back to the terms in a moment, but and you'll be very popular with this audience talking about providing that kind of financing. So basically where you're focused is first lien lending. That is sort of your bread and butter. Do you do other things beside that, or is it mostly that?
We have focused primarily on first lien, mostly because, as I mentioned, the supply or the demand has been overwhelming in that space, both from an acquisition of secondhand vessels as well as to some degree discounted refinancing of existing bank mortgages. So we've been quite busy. In fact, we've become one of the more active lenders in the world in this space in the last couple of years. So
we'll come back to you. Very interesting. Let me just jump over to Philipp. And Philipp, what does Berenberg Bank do? What kind of financing do they provide to the shipping industry?
Yeah, I think it's fair to say as a bank, we offer a variety of things. As you know, we are quite strong in our investment banking activities, so we offer ECM, DCM type of funding to the industry. I think this is quite standard in a way. On the other side, it's worth mentioning that Hapag-Lloyd was kind of done by ourselves, but also more recently here in the Greek market, the market reopened for bond issues, maybe not in the shipping space first, but this might come up. So these kind of, let's say, more standardized alternative sources we offer as Berenberg. At the same time, we look, and it's fair to say that we have never been and will never be the big time lender to the industry, as our own balance sheet is not big enough simply as a private bank. So this protected us also over recent years. But what we see is a certain need of the whole client base we have, and this is a huge client base in shipping for these kind of new financing as the more traditional banks just exit the sector or are at least more reluctant. So we are approached by our clients, and that's why we then have to look for good solutions. And so two priorities at the moment. One is on kind of unitranche financing, where we try to combine, let's say, what our competence as a bank and the competence and flexibility of private equity fund, which is willing to offer a more risky part in kind of a junior mezz piece. Whereas we as Berenberg would invest in the more senior part of that loan. So altogether we can offer a bit more than we would do on our own balance sheet. And I think this copes quite well, especially as for you as our clients. The good news is that we try to be a one-stop shop here. So you would talk to us, and we would line up this private equity investor behind us. So anything which comes to organizing that is then done by ourselves and offered to you as one product, which might be interesting. Second thing I think which is worth mentioning here, it's maybe not so obvious, but as many banks are reducing their portfolio, also I would say the everything which is with regard to portfolio sales or loan sales is a kind of alternative financing today. And we see our role here to bring more institutional investors with a certain idea of return requirements, but with probably often no idea about shipping. At least in the beginning, to bring these investors together with you guys and have then a combination where we could offer new financing by just buying the loans at a discount, for example, and then I think this is also a way to refinance if one of your traditional banks will or want to exit the sector.
Yeah, just on that point, before we move off at buying existing loans at a discount, I mean, it's very helpful to the borrower company who has excess tonnage and can take some debt off their balance sheet. When you do that, do you restructure the loan at the same time, or do you just buy the loan and move forward?
I think as Berenberg, we tend to let's say focus on the more performing loan side, or maybe sub-performing, but the really distressed ones is maybe not so much our field, because for us as Berenberg it's also always important to have still a living entity behind that loan. So the loan might be in distress or might sub-perform, but the background should still be healthy in a way, and so I think we don't talk on the most risky distress part, but rather on the less risky part, where the discount is a bit less maybe. Okay,
let me go to George. George, what have you been up to, and what are you seeing in the market in terms of alternative financing structures?
Well, from our side, one major change we saw in the last few years is the increased participation of ECAs in deals. So, and very recently we closed a very big deal involving a big syndicate and Korean new buildings. Another element that we've seen a lot is Chinese leasing, and although that's going to be the subject of a separate panel, I don't want to get into too much detail, but that is something that is very much alive, and there seems to be a great deal of interest both from China and also from owners in this market. We've done a number of sale and leaseback deals involving, particularly arranged in Norway. So that was last year. I don't know how that market is this year. And clearly the other big change has been the increase participation of private equity and hedge funds. And very recently we're seeing actually some very big ticket deals which are coming to the market with actually established and well-known names in this market. We won't talk about the terms now because we'll get on to that, but that seems to be a very significant change, because so far mostly we've seen funds participating on the equity side, so in creating joint ventures. Now we're seeing also an increase in the number of specialists, either long established or more recent funds, who are specialist providers of finance to the shipping industry. They're playing an increased role, and to a smaller extent, another source of finance, I mean, and it is non-traditional, is that we also found that there was an increase in the amount of seller's credit being offered by shipyards as a result of the falling values of new buildings, which created a significant gap between the bank finance and the owner's equity. So those are the type of things that we've seen over the last few years.
Yeah, thank you, George. I just want to mention what I've seen over the past couple of years as well, and certainly we saw private equity coming into the industry and doing a lot of mezzanine financing, but that seems to have dried up over the past couple of years. Now we see private equity doing more joint venture kinds of deals that George is talking about, which again can be helpful to shipping companies looking to offload some assets and clean up some debt and just improve their balance sheet. But other pools of capital coming into shipping, one large insurance company that's comfortable with shipping has been taking a first lien lender position in large facilities, and it's, one of the benefits of these alternative financing sources is you're not dealing with this larger group of lenders, and it's a little easier when times are difficult, to work through amendments and to get the kind of cooperation that you need. I agree with George that lease financing has been popular. The other thing is just creative structures. We work with a shipyard, one of the two shipyards in the U.S. that builds product tankers for the U.S. domestic market, and they were coming to the end of their order book. Their solution was to form a new company, which they listed on the Oslo OTC. They raised some private equity capital and put in half the money themselves and did 4 contracts on a speculative basis. and then sold those into the market before the first ship was delivered. So, I mean, there's some creativity that companies are employing as well. So let's go back here a little bit to the terms and more specifics about the kind of deals you're doing. And Stephen, I'll start with you again. How about deal size? Kind of what's your sweet spot? And is it always just you as a sole lender? Do you partner up with people?
Sure. So I think part of the structural advantage that we have is being able to operate as a pure play specialty lending company. What does that mean? It means that we have the experience, perspective, the integrated skills, and the best practices that traditional financial institutions employ, but we have the luxury of not being structured as a bank and being regulated as a bank. So I think relative to bespoke approach, size, optionality, while we have basic conforming parameters of the type of transactions that we're looking at, we do have a high value add in the custom approach that each loan needs and deserves. Average transaction size for us is 10 million and up. We're typically looking at, again, 5 to 15 year old utility tonnage, and 50 to 60% type of advance rates, a little bit higher cost of capital than I think those borrowers are traditionally accustomed to.
Can you talk about a range there? Just give us a sense.
It's probably high single digits, low double digits all in. That's what the North American institutional investor is looking for. And I think that's about as wide as you can stretch senior financing without breaking the integrity of the structure or making it too onerous to the borrower. I can tell you that we've as I said, been very active in the space. We've been fortunate to be working with an extremely strong pool of borrowers, great operators. We've not had any impairments, no defaults. We haven't had a late payment. So I think we're slowly debunking the myth that higher cost of capital doesn't work. I think the reality is when you're focused on a segment of the market that really is the majority of the market, this is the heartbeat of the fleet that we finance globally, and that operator is seasoned. They've got low leverage levels. Their business is not engineered at a much higher cost basis, as many of the public companies are, and they've got a lot of their own money in the business. And so those things are important to us when we look at quality of borrower, just as we look at quality of asset and integrity of structural, the transaction structure, pardon me.
Philipp, describe the kinds of deals in a little more detail that you do.
Yeah, I think could add to what Steve just said. I think it's important to understand that most of the funds or the funding we see from these investors right now have been collected or have been raised earlier, so with a certain expectation of return, which is let's say low double digits, high single digit for these kind of debt. So you might ask, how should this work with your project in these times where the cash flow is not really visible? And I think it's fair to say that it is challenging to accommodate this requirement with the project availability. But at the same time, we see more and more funds now rethinking about their return requirements, especially as the whole alternatives, what they have come down in terms of returns. So we might see a next wave of capital coming in, which is a bit more mature and a bit more sensitive to the industry when they got accommodated with the first deals. So I would say what we need is to educate more long-term institutional investors, and that's what we work on. It's quite a tough work over time. I think you will agree, Stephen. But we need these investors in order to bring down a bit the return requirement and make it more feasible for the shipping industry. On the feature side, maybe one aspect, we are well aware in our structure that the today's cash flow might be a bit stretched. So what we would offer is kind of a PIK element in the junior interest, so that the cash flow today is a bit protected in a way, and there's an element which comes at the end of the whole structure. But this is very individual and always a matter of the concrete project, of the segment, of the size. But for the rest, I agree with what Stephen said on deal size and tenor and so on.
Yeah. Just on the tenor point, give me a sense of tenor of your typical loan.
It's for us. We normally see between 3 and 5 years structure. Everything beyond 5 years is then probably attached to a cash flow. But these are probably different deals. So I think 7 years would be feasible, but the sweet spot, if so to say, is 3 to 5 years.
Mm-hmm. And are you heavy on covenants, financial covenants, and those kinds of things, or is your philosophy to be a little looser on those?
I think still there are often non-recourse structures here for these kind of financings. So the number of financial covenants in that sense is limited. Mm-hmm. However, with regard to the rest, I think the usual covenants which you would expect also with other financings are there. The main challenge here is to, let's say, do the intercreditor between the fund and the senior, so between the junior and the senior financing, and this is maybe the more challenging exercise here.
Mm-hmm. Mm-hmm. George, like to add anything?
Well, I mean, in terms of the deals we see, we've seen it. It does vary from where you have very specialist lenders involved, where you can see relatively small one-ship deals, but we've seen very big deals. Especially, there are a couple right now which are being negotiated with funds. And other than the elements which were discussed, so in terms of the interest requirements, one aspect we see a lot of is a PIK element being built in, but also where funds are involved, we're seeing a sharing of the upside. So we see equity kickers a lot as well, and that's a feature which distinguishes this type of financing from conventional bank financing.
Yeah. Now, Stephen, I looked a little bit on the internet about your group, and I guess it's part of Four Woods. Is Four Woods also involved in some vessel management and operating?
No, we're not. We are our specialty lending operation is strictly involved in lending. Mm-hmm. I think what that's naturally created as a product line extension, if you will. I think given the store of value, if you will, that I think lending creates and a captive relationship with borrowers. Those borrowers, if you're picking them properly, are the ones going up the ladder, and invariably they will need other types of services and advice, capital formation, advisory work, M&A, and so as a natural outgrowth of our core lending business, we have incorporated more kind of a traditional investment banking services that we're now starting to incorporate in that market.
Yeah.
Brett, let me just jump in. We're out of time, but I just want to ask if is there any question perhaps from the floor? No, then just one quick question and 1 minute response from each of your panelists if you have.
I thought you had a question.
Yes,
okay. Well, I'm just trying. Is there anything in particular?
Let me ask the question.
Yeah, sure.
We're in Greece, of course. The Greek market has a lot of kind of middle market owners who are starved for finance. Let's say, how important, Philipp and Steve in particular, is the Greek market to you guys?
It's the core of our business. We've got 6 professionals here, 2 in London. This is the market that we're focused on, and access to this market creates a global footprint in our portfolio. So for us, this is really the epicenter of the middle markets, and it's where we've employed our professionals and where we have a local market operating model.
Perfect. Philipp?
Yeah, I think same goes for us. As most of you know, we are since 50 years here in the Greek market, so it's next to the German and the Cyprus markets, the most important, by far most important market here, and we're happy to be here and see things moving.
Thank you. Perfect. Okay, we're out of time, so Brett and panel, thank you very much indeed. Thank you.
Thank you.